This session will be led by Rohit Rana. He is the SVP at SunTrust Bank. Rohit leads a team which is tasked with developing a broad set of quantitative tools to address business requirements for marketing, account origination, portfolio management, collection optimization, and also to address various regulatory expectations. Over his 20-plus years of experience in financial service industry, he has developed an in-depth knowledge on how data drives key decisions across the various departments in a given bank. He has an undergraduate and graduate degrees in statistics and econometrics. In addition, he is a CFA charter holder and a certified financial risk manager. He is also an investor and advisor in ventures that leverage non-traditional use of data. Please join me in welcoming Rohit to the stage.
Let me see, can everyone hear me? Hi. Thanks for waiting up. It's always tough to give the last lecture. And on the positive side, it's when you think about it, it's kind of a survivorship bias. So anyone who's still surviving is definitely interested in credit scoring. So I'll try my best to create value for everyone. Okay, let me see. This is... okay. So this is pretty much our agenda. And my objective is to look, one of the advantages of having a topic which is more focused is that I can be more specific. And the advantage of specificity is I can provide some templates, some more pointed solutions. And I'm not looking at something 10 years hence. I'm looking at what I feel is a scenario and a template possibly to use machine learning and AI in credit scoring, probably in the next 3 or 4 years. That's my opinion again. And before I go, I forgot to disclaimer, totally forgot that. The views presented are personal and do not reflect those of SunTrust Bank or Truist, the new entity. Truist. I'm still getting used to it. Again, I'm trying to define terms over here. And my purpose for defining these terms is not to come with an all-encompassing definition. And neither is it for getting the right definition. It's a way I'm kind of scoping the whole discussion. Big data. It's pretty obvious, but what I would stress on is big data is not just the data that is existing outside the organization. In a given bank, there's tons of data that's existing out there. Your DDA data, your data on whenever an RM is talking to a business or the company, any notes they're making, the tenor of those notes, emails. All of that is data that is existing inside the organization, and it's a very rich source of data. And I'll talk about some of the use cases around it. The next is machine learning. To me, machine learning, or the tools that you call as machine learning algorithms, are not significantly different from any of the statistical techniques which are currently being used in the organization. They are, how should I say it, the way I define it, they're less constrained. They're just less constrained. And ultimately, it's a mathematical algorithm. Artificial neural networks is a mathematical algorithm. People say a version of artificial neural network is a logistic regression, which is very extensively used. It's just a very huge algorithm. That's all it is. But it's still an algorithm. Artificial intelligence, the way I've defined it, is a broad set of algorithms that can intelligently interpret data, find patterns in the data, and update them independently. So that's what I would call as a machine learning, an artificial intelligence, in the context of banking, in the context of scoring. Again, scoping. I'm taking some liberties out here. I think when we talk about credit scoring, we traditionally talk about underwriting, lending credit to a new customer, rejecting, accepting, pricing. But the scope of scorecards goes way beyond that. It's prospecting. You have prospecting models. You have response models. You offer someone credit line increase or credit, whether the person accepts it or not. Again, response model, the scorecards. Underwriting new customers, of course, pricing them. Portfolio management, existing customers. Increasing the line, decreasing the line, and selling new products. You could be selling a mortgage to a credit card holder. Again, it's all portfolio management. I call that all portfolio management. Collection optimization. Again, part of the portfolio management where you're decreasing the line, you're trying to reduce exposure is somewhat related to collection optimization, but collection optimization is really the last stage of the process. You have two people, just very, very briefly. One of them is both are delinquent. They're not paid their money for some time, maybe 30 days or something. You don't know who should you go after. It's a resource optimization issue. Someone would be lazy, forgetful, and there is someone else there is genuine stress. And there are a lot of, there are quite a few scorecards which use that, and there are different stages which you can have collection optimization. Methodology used, again, typically banks use logistic regression. That's predominantly, 95% of the models will be using that. You'll have some which are hazard models, survival models, but that's more of an anomaly as far as a bank is concerned. Okay, now we'll try to move something more interesting. I've scoped it out, what I call as a scorecard. I like to start deliberately with a credit timeline. There are three events, or call it an event, or three stages of credit risk. There is an event stage, and there's a discovery phase, and there's confirmation. Event is something very difficult to identify. And again, I'm going to link all of these to data that is available. And when you talk about event could be medical reasons. It could be sudden stress on cash flows. It could be midlife crisis, you're divorcing and all that stuff, and happens a lot. And so it could be any of these which can create stress. It's very difficult to identify stress in a consumer or a small business world. Really, I'm not talking about big companies. Then there is a discovery phase. Discovery phase is really more around, like we say, payment behavior. You miss payments. You're difficult to reach. And that's kind of the discovery phase. And then confirmation is straightforward. It's when a person eventually defaults. And so scorecards typically focus on the discovery phase. And they will use internal data, past behavior, and your capacity to pay, which is more of a static factor, leverage and all that. Then you also use credit bureau data, and they have a rich source of data for that. The strength of a scorecard and how much of value it creates, especially in portfolio management, collection optimization, anytime you're upselling and reducing credit, is how close you are to that event phase. That is the key. You got to be close to the event phase, as close as possible. And before I start with the use cases for scorecards, I would like to talk a bit about data availability. And again, the reason I'm saying that is creativity and innovation is an iterative process. It doesn't start with necessarily, and I know there are a lot of use cases being talked about. It should have a use case, it's a business case. A lot of time it's an iterative process where it starts, it could be a top-down process. You have a problem, you need to solve it. It could be a bottom-up process. And I'll tell you a story, and I'll make a case for social media and all those kind of data, and I'll introduce some more concepts out here. So I live in a suburb of Atlanta, 85 houses. And we've seen sale of 25 houses in the last 2.5 years. That's pretty high for a neighborhood that is not stressed. It's fairly good school districts and all that stuff. And And the person who's able to predict that very well is my wife. She knows it. And she's predicted at least 14 out of those 25 of sales of houses and all that stuff, which are up for sale or which are already being sold. And she gets that information from Grapevine. Almost all of them are related to marital stress. They're divorcing and all that stuff. Balance are, of course, they are empty nesters and all that stuff. So it's interesting that you have a data source. So I'm looking at creativity out here. I can look at a use case, okay, I need something good for portfolio management, I need something for a collection optimization, but I have a data source which is a very rich source of data, which is social data. And so that is, when I look at data that can be in future, barring the regulatory issues, privacy issues, and all that stuff, which can really create a lot of value, is social media data. And again, when you talk about social media, you can talk about, I'm including a lot of other things. I'm including Yelp. I could even include Facebook, probably. Just to give you an idea, if you are lending credit to a restaurant, and typically a lot of these are mom and pop shops. You have a Mexican restaurant, someone comes out there, he can't even speak English, he wants to open a restaurant, or he has a restaurant out there, he wants some credit for some boiler or burner, whatever. The best way you can get data, you go to Yelp and see the number of likes. And a lot of fintechs are already doing that. Social media behavior, let's talk a bit more about it. There are a lot of companies in fintech space. Again, I'm focusing a lot on data. It's kind of a bottom-up process. I don't know if anyone has heard of a company called Happy Money. No, Happy Money. It's up in LA. And there's another company which is somewhat similar to that. In these companies, they have almost 1 million customers each, at least, and it's growing. They typically allow you, one of them has an app where if you buy anything, you can score the company's product, or you can score the company how environmentally conscious it is. Okay? And they have a very strong following. There's another company which allows you, it provides retirement accounts. It allows you to set your own, or decide on your own fees for the retirement accounts. So you think about these customers that are coming up, especially in the millennial space. It's very difficult to mine that kind of data, creating customer segmentation, looking at risks, just by traditional data sources. And that's why I'm proposing some of the data sources out here, which can create a lot of value. Internal bank DDA data. Surprisingly, banks have a lot of data on checking accounts, DDA data for small businesses, mid-sized businesses. They don't mind them. There is and all of these data sources have a specific characteristic. And that lends to challenges in modeling. It's very noisy. And when I say noisy, what does it really mean? Long story short, it leads to a lot of false positives. You have a lot of signals. And typically standard techniques, logistic regression and all that, which are more somewhat linear, it's difficult to identify an objective function in that because it's very much more complex. Formats can vary. You have textual formats, non-textual formats. And of course, the third one is regulatory challenges, the privacy issues and all that. And then when I'll talk about my use cases, I'll talk a bit more on this stuff. Traditional storage mechanisms are not ideal. Storage is a big deal for this data. And you typically, a single source of data is ideal. It's very difficult to build solutions and implement the solution if you have different tables which have different sets of data and create some kind of a mathematical algorithm out of that, which can be implemented on a consistent basis. Does anyone remember 5 C's of credit? You have 5 C's of credit, which typical credit analysts do. So one of them is capacity to pay, collateral, cash flows. There are two of them which are very important, which is character. Again, no moral judgments here. And another is conditions. A lot of use cases exist from estimating these two data points or these two characteristics of credit risk. Let's talk about some of the possible use cases. And again, I have bifurcated these use cases based on the regulatory scrutiny you'll have. Anything, and when I talk about underwriting models, anything that is dealing with granting credit to a new customer is fraught with significant amount of regulations. And any advanced machine learning technique, I think in the foreseeable future, next 1 or 2 years or 3 years, is difficult to implement if it is not transparent enough. But there are opportunities that exist in portfolio management, line increase, line decrease, collection optimization, prospecting. You can prospect. You can prospect customers based on, let's say they are. I would say if you go to the registry and all that stuff, and you can find someone is getting married, obviously you can sell a mortgage loan to them. So there are a lot of opportunities that exist in all these spaces, which have relatively less regulatory scrutiny as compared to underwriting models. And again, when I talk about data, I'm going to throw one more concept out there. It is called as simultaneity. It's an interesting concept. Basically, what it means is typically in any mathematical algorithm, you have the x variables, which are independent variables, which are driving the dependent variable, which is the default in this case. All these sources of data. Now, anyone who goes for credit, typically you clean up your balance sheet. You pay down your loans and all that stuff, increase your credit score and everything. So what happens in those cases is that you have dependent variable, which is the default, influencing the independent variables, which could be your leverage, which could be your credit history and all that stuff. All of these data sources, which are non-financial data, are noisy, but they do not lend to this kind of a corruption, which happens because of simultaneity. So again, that's some of the use cases. I think over last two days, we've seen a lot of techniques which can be used for machine learning, and these are some of the techniques which I have used, and I found them quite useful. Sentiment analysis. Support vector machine is one of the techniques, and what we have tried to do over here is, at a very basic way, we have gone to the textual data, which is typically relationship managers, their notes and all that stuff, especially when they talk to clients, and mining that textual data to create sentiments, positive, negative, and based on that, we've created scorecards. And they have been reasonably successful and a good overlay if we were to add it to the models. Artificial neural networks, definitely when you're dealing with noisy data. I would say deep neural networks, which is layers of artificial networks, is slightly difficult to handle because again, the visibility decreases significantly. Random forests, both supervised, unsupervised. When you talk about supervised versus unsupervised, supervised is typically you have a dependent variable and you are kind of solving for that. Unsupervised, you don't have a dependent variable. And one big opportunity is using unsupervised techniques around data quality, data checks, and patterns. Last point, it's difficult to use textual data as is for credit score or in a quantitative model. Typically, you can use them as scores. And again, I personally think that's a big opportunity for specialized companies that can create something like a social score or a non-banking score, which can be sold to a lot of banks. My next 4 or 5 slides is on risk. I think my opinion personally is that building a model is only 20% of the job. Majority of the work and the constraints are around the risks. You have to manage the risk somehow. And obvious risk is black box model, like someone just said, I think in the morning that is, they skip the question of why. You have a bunch of inputs, and then you have an output. And anytime you deal with credit, the question on why has to be answered a lot. Again, relative weights in artificial neural networks, you don't get to know what are the weight of different attributes, which is pretty obvious in a lot of standard models of logistic regression. And again, model overfits. You have this huge problem of model overfit, and which is more pronounced in these neural networks. Biases, again, all of these are typically standard modeling challenges. Last one is privacy issues, which I've already talked about. Anytime you deal with underwriting models or even portfolio management models, there are fair lending risks. And traditional platforms, and I'm not naming them, I think, like, for example, maybe SAS, which is extensively used with the banks, are not typically ideal for text mining. Replicability of results. You can't be sure that you'll get the same result every time with the same set of inputs. Again, that goes to the why question. I'll give you an example. I tried to, last point is that SR 11.7. SR 11.7 is a regulatory guidance on model risk. It's a pretty good guidance, but if you were to go by that exactly and create a documentation based on that, the last documentation I created, I could not upload it. It was so big. And this was for a very standard, simple logistic regression model. Can you imagine what's going to happen if you build something for an artificial neural network? And one of the dirty secrets of banks is that, not SunTrust, okay, that banks typically invest a lot in model development resources. Model validation teams is considered as a cost. So they're not adequately resourced today. And very few banks have the infrastructure, especially in model validation, to validate these models and create that level of comfort for the regulators. Again, I've tried to create a somewhat of a template, given those kind of risks and the opportunities that exist, which can be used for implementing these artificial neural networks or machine learning models, decision trees on gradient boosting models are. One of them is creating transparency. And there's some standard techniques which have been used and which have had some success with the regulators. One of them is the LIME approach. And I've practiced this word quite a bit. I still can't get it right. It's local interpretable model agnostic application. It basically means that if you have a machine learning algorithm, you create a surrogate model, a simple, transparent surrogate model, which tries to predict the same thing, which is, in this case, would be a default. And based on that, you create a bit of transparency in the model. So that's answering the question of why. Same, other way is you can create transparent techniques to or two different layers of models. You can have a logistic regression model, and then you can find the attributes based on that, and then you can create an artificial neural network or a deep neural network based on that. So you're creating some kind of a transparency in the attributes at least being used. And then there are standard techniques, outcome analysis, shocking various inputs, parameters, scenario analysis, setting boundaries for output. You know, if your model is giving a Gini coefficient of 95%, there's something off completely. If I were to look at, besides investing in a single data platform source, the biggest impediment on, and other than the regulatory, working with regulators, the single biggest impediment is not model development. It's getting the validation teams, the supporting infrastructure around that, to be up to speed and resourcing them appropriately. And I think that's a big challenge for the banks today. Other stuff is like backend infrastructure, one single data platform, which can use both ideally textual and non-textual data to manage these risks. So that's pretty much at the end of it. I wanted to leave some time for questions. If anything on what I feel as far as credit scoring is concerned, what could be the long-term scenario, and what could be the drivers of AI. We're open to that.
Oh, thank you so much. Great presentation. Would love to dive a little bit further at the work you've done at some of those transparency approaches you mentioned, like Lime.
Sure.
And tell you a little, if you could share a little bit more about your experience. We've heard the word explainable AI probably mentioned more times than we can all count in the last 2 days, and would really like to understand your practical experience working with some of these explainable AI technologies.
So, again, banks, I still think, are somewhat behind other organizations in using these techniques. So I'll talk about a technique which we use, which was for underwriting models, which was a gradient boost approach. And this was for an underwriting model. It was a new portfolio. We didn't have a lot of data. And the way we handled that was with the regulators. First of all, it was rejected right away by the model validation team. And it's still being under approval, at least going through an approval. But what we did was we created a logistic regression model in that. So we created a very transparent model, which was giving somewhat similar results, not that good. And that's the way we created a surrogate model, became more transparent, and they at least, we had the boundaries around the output, and we felt that that way we could validate our model that way. Yeah, that's what we did. Right. Yes.
Yeah, I'm wondering if you've explored simulation models that will, as you're underwriting the client, for example, run cash flow simulations for future payments, sort of breaking down the risk across, different types of predictors.
Sure.
In the context of how they may or may not pay back the loan, for example.
Not as of now. And surprisingly, there is a lot of, in banks, you have a lot of stress testing models, which can easily be used for the kind of analysis which you're talking about. But you would be surprised, a lot of model development in banks works in silos. No, we've never used them. But I'm sure the resources exist over there.
You talked about lack of resources in model validation, but not at SunTrust. So how did you get there, and what are your validators doing? Are they monitoring as well, and they're supporting? What are the skill sets?
I don't want to dwell on skill sets. Let's talk about resources. It becomes a sensitive subject. I'm telling you from my practical experience. When I joined one of the banks, again, I won't put names. I was offered the position of head of validation initially, and again, like any model developer, I find validation slightly boring. So I said, I'll go for the model development job. So they gave me a peer position in model development. The salary offered was 65% higher for the same grade, same level. That's just to answer your question on what kind of resources banks have been throwing in model validation. Model validation has been typically considered as a pure cost. Pure cost. And their objective many of the times is just to make sure that you minimize that cost. And when you go with that approach, I can tell you the biggest work for today to implement these kind of solutions, maximum work is with model validation teams. They have to work with regulators. They have to to look at the risk of the models. It's much easier to develop a model than manage the risks around it and validate it and put your neck on the line on there. So yeah, this is my experience with most of the banks. Sure.
All right.
Thank you.
Thank you so much.